Okay, let's play a game. It is January 2026. You are looking at a 40-year-old software giant, a company that for decades was basically just the icon you clicked to fix a photo or, fight with a PDF file. But now they are looking the market in the eye and saying, we aren't a tool company anymore. We are an AI-first platform.
It is a massive pivot. I mean, maybe the biggest we've seen in software history. And if you look at the raw data we have for Adobe's fiscal year 2025, the sheer scale of this transformation is frankly staggering.
That is exactly what we are unpacking today. We are doing a deep dive into Adobe because on the surface, everything looks fine. But when you look closer, there's this fascinating tension. You have the market, which thinks Adobe is a legacy dinosaur about to get eaten by AI. And then you have Adobe claiming they are actually the ones doing the eating.
And the numbers tell a very conflicting story, which is why this is such a good case study. Adobe just wrapped up fiscal year 2025. Revenue hit a record $23.77 billion. That is up 11% year over year. Operating cash flow topped $10 million. By any traditional metric, they are printing money.
All right, $10 billion in cash flow is enormous. That's real money in the bank. So if I'm holding the stock, I should be happy.
Well, here is the disconnect. Despite those record numbers, the stock is trading at a historic discount. We are looking at a PE ratio, price to earnings, of around 19x. For context, their 5-year average is usually around 32x.
That is a huge drop in valuation multiple. That's nearly half the premium they used to command.
It is. Wall Street is essentially pricing Adobe like it's a slow-growth legacy business. They are pricing in a funeral. Meanwhile, the company itself is screaming that it has successfully navigated the biggest tech shift since the internet.
So let's find out who is right. Is this a dinosaur walking into a tar pit? Or is this a sleeping giant that's currently on sale? To understand that, I want to start with the architecture. Because usually corporate reorganizations are boring. Like glaze over and check your email. Boring.
Usually, yes. It's just moving deck chairs on the Titanic.
But in this case, the way Adobe is organizing itself seems to tell the whole story of their strategy. They aren't just digital media and digital experience anymore in how they pitch the vision to the street.
No, they've really simplified it into 2 mega segments that reflect the AI reality. The first one is business professionals and consumers. This is really interesting because it merges Acrobat, which we think of as boring productivity, with Adobe Express, their creativity tool.
Pause there for a second. Why merge those? Acrobat is for contracts, invoices, reading long documents. Express is for making Instagram posts. They feel like opposite ends of the spectrum.
Because in 2026, those worlds have collided. Think about it. If you are an accountant or a project manager, you live in Acrobat. But suddenly, your boss wants a slide deck or a visual summary or a social post. You don't want to learn professional Photoshop. It's too hard. You just want to click a button.
So I'm a PDF, and I just want to turn that text into a visual. I don't want to leave the app.
Precisely. The goal there is frictionless onboarding. They want to democratize creativity for billions of users. It's a product-led growth strategy. You're in a PDF, you use the AI assistant to summarize it, and then boom, you're in Express, turning that summary into a visual presentation. It's one single workflow. They are trying to capture the non-creatives before they go to Canva or somewhere else.
Okay, so that's the everyone bucket. What about the pros, the people who actually pay the big bills?
That's the second group, creative and marketing professionals. This merges the traditional Creative Cloud Photoshop, Premiere with the Experience Cloud. And the key word you need to understand here is the content supply chain.
The content supply chain. That sounds very industrial, very manufacturing focused for an artistic company.
It is industrial, and that's the point. Enterprises don't just need a pretty image anymore. They need thousands of assets, personalized for every platform, managed, tagged, and measured. So Adobe is linking the making of content with the management of content. It's about power and precision.
So they've reorganized the house to fit this new reality. But let's talk about the elephant in the room. The thing that I think scares every investor and probably half the designers listening to this. Why wouldn't I just go to Midjourney or ChatGPT? If I can type, make me a logo into a chat box, why do I need Adobe?
This is the existential question. This is why the stock is trading at 19x earnings. The market fears that good enough AI kills the need for professional tools.
Exactly. If the AI is magic, why do I need the wand?
Adobe's answer is what we call the aggregator or Switzerland strategy. Instead of trying to fight every new AI model that comes out, Adobe has decided to swallow them. As of late 2025, if you are inside Adobe Firefly or the Creative Cloud, you aren't just limited to Adobe's models. You can access OpenAI, you can access Google's Gemini and Imagen, you can access Runway for video, all within the Adobe interface.
So they are becoming the interface layer, the browser for AI, effectively.
Exactly. They are the middleware. And this connects to a concept management talks about constantly, toolability.
Toolability. Okay, let's unpack that because it sounds like marketing jargon. What does it actually mean for a user?
Think about it this way. You go to a standalone AI generator, you type a prompt, you get a weird image of a cat. Maybe the eyes are wrong. Maybe you want the cat to be holding a soda can, but specifically a red soda can. In a chat box, you have to re-roll the dice. You have to type, no, make the can red, and hope the AI doesn't change the cat's face in the process.
Right, it's like a slot machine. You pull the lever and hope for a better result. It's probabilistic.
Exactly. But in Photoshop, you generate the cat, and then you have layers, you have vectors, you have masks. You can non-destructively edit just the eyes or just the can. That is toolability. Adobe's bet is that professionals can't replace a complex workflow with a simple slot machine. You generate with AI, but you refine with Adobe.
That is a really key distinction. It's the difference between getting an image and doing work. The chat box gives you an output, but Adobe gives you control over the output.
Right. And there is an economic layer to this aggregator strategy, too. Adobe is actually monetizing those competitor models.
Wait, how does that work? If I use OpenAI inside Photoshop, who gets paid?
You pay Adobe. Adobe uses a currency called generative credits. We'll get into the financials of that later, but essentially, Adobe puts third-party models on their own REIT card. They manage the back-end costs with Google or OpenAI, but the customer stays sticky to the Adobe interface. Adobe owns the customer relationship. The model providers just become utilities in the background.
That is actually pretty brilliant. It turns competitors into suppliers.
It commoditizes the models. It treats OpenAI like electricity. You don't care where the electricity comes from as long as the light switch works. Adobe owns the switch.
But there's another angle here that the sources keep mentioning, and it seems to be a huge deal for the big corporate clients. The legal moat. Is this still relevant in 2026?
It is arguably Adobe's biggest superpower right now. If you are Coca-Cola or Disney or a massive bank, you are terrified of copyright lawsuits. You remember the mess with the New York Times suing OpenAI back in the day? You cannot risk using an AI model that was trained on scraped data from the open web.
Because if that model spits out Mickey Mouse or something that looks like a copyrighted photo, and you put it in a Super Bowl ad, you're liable.
Exactly. And corporate legal teams do not like liability. So Adobe's Firefly is trained only on licensed Adobe stock images and public domain content. It is a clean model. Because of that, Adobe offers IP indemnification to enterprise clients. They literally tell these companies, if you get sued for copyright based on our output, we will pay the legal bills.
That is a level of confidence that a startup just can't offer. A startup doesn't have the balance sheet to promise that.
No startup can touch that. And it goes a step further with something called Firefly Foundry.
Oh, right. I saw this in the notes. This is the customization piece?
Yes. Firefly Foundry allows a company, say a movie studio, to train a custom model on their own IP so they can feed it all their character designs, their backgrounds, their style guides. Then their designers can generate content that is perfectly on brand.
So it creates a localized network effect.
Correct. The more they use it, the better the model gets for their specific brand, and that locks the customer in. If you spend a year training a Firefly model on your brand assets, you aren't going to switch to a competitor next week. The switching costs become incredibly high.
Okay, so we have the architecture, we have the strategy. Let's talk about the money. Because for a long time, Adobe was just selling seats. You buy a subscription, you get the software. But the sources mention a shift to a hybrid model. This feels like a significant change in how they make money.
It is the shift from SaaS software as a service to SaaS plus consumption, and the vehicle for this is those generative credits I mentioned earlier.
So how does a credit work in practice? Is it like a microtransaction?
Sort of. Every subscription comes with a monthly allotment of credits. Generating a simple image might cost 1 credit. But complex tasks like generating high-res video or using those third-party models we talked about cost more credit.
It's like data on your phone plan. You get a bucket of data, and if you stream 4K video all day, you burn through it.
Very similar. And the metric here is explosive. In Q4 of 2025, credit consumption increased 3x quarter over quarter.
3 times. In 1 quarter. That's not normal growth.
It's exponential. And that is a leading indicator for revenue. Because when power users run out of credits, what do? They have to upgrade their tier or buy credit packs. It allows Adobe to capture the upside of heavy usage. If you are grinding out thousands of AI images, you are paying more than the casual user.
And this connects to what they call AI-influenced ARR, annualized recurring revenue. The sources say this has surpassed $5 billion.
That's right. That's more than a third of their total book of business. It proves that AI isn't just a novelty toy feature. It is driving retention and upsells across the board. People aren't just playing with it, they are paying for it. It suggests that the AI features are actually solving problems, not just creating shiny demos.
Speaking of upsells and expanding the business,
Yeah.
we have to talk about this acquisition. Adobe intends to acquire SEMrush.
The $1.9 billion move.
Yeah. When I first saw this, I scratched my head. SEMrush is an SEO tool. Marketing people use it to find keywords for Google. Why does a design company need that? It feels like a distraction.
You have to connect the dots to something called GEO, Generative Engine Optimization.
Okay, GEO. I'm guessing that's the successor to SEO.
Exactly. Think about how search is changing. People aren't just Googling links anymore. They are asking chatbots, ChatGPT, Gemini, Claude for answers. If I ask a chatbot, what is the best running shoe for flat feet? It gives me an answer. It doesn't necessarily give me a list of blue links.
Right, and if my brand doesn't mention that answer, I'm invisible.
Precisely. Brands are terrified of this. So by buying SEMrush, Adobe is closing the loop. They already help you create the content with Creative Cloud. They help you manage it with Gen Studio. Now, with SEMrush and their new LLM optimizer tools, they help you ensure that content is actually visible to the AI models that consumers are using to search.
That is wild. So it's not just make a pretty picture, it's make a picture that the AI algorithms will like.
It connects content creation directly to marketing performance. It turns Adobe from a tool vendor into a business results platform. If I'm a chief marketing officer, I don't just want a logo. I want a logo that ranks. Adobe is saying, we can do both. It's a very smart defensive move to stay relevant in the marketing budget.
So if we look at all this, the hybrid model, the aggregator strategy, the legal moat, the SEMrush acquisition, it sounds like a slam dunk. It sounds like they have it all figured out.
Yeah.
But we have to play devil's advocate. There is a bear case here, and it's a strong one. It's the fear of seat compression.
This is the fear that keeps investors up at night. The logic goes like this. AI makes designers 10 times faster. If a designer is 10 times faster, a company doesn't need 10 designers anymore. They need one. If they fire 9 designers, that's 9 Adobe subscriptions that vanish.
It's a logical fear. If the software is too good, does it cannibalize the user base? Does Adobe automate itself out of existence?
That's the seat compression theory. But Adobe and the bulls argue for the opposite, seat explosion.
Seat explosion. Okay, that sounds optimistic. Convince me.
But the argument is based on price elasticity. As the cost of producing content drops, the demand for content doesn't stay flat. It explodes. This is known as Jevons paradox. Companies need more content than ever. They need personalized videos for TikTok, Instagram, YouTube Shorts, email campaigns, localized for every region.
So instead of one generic ad for the whole country, I need 50 variations for every state.
Or 500. And this is where the content supply chain comes in. Enterprises are drowning in this need for volume. They aren't firing designers. They are trying to automate the grunt work so their teams can actually keep up.
I see. So the designer isn't spending 3 hours cropping photos anymore. They are managing the system.
Exactly. And there is a multiplier here. Agentic AI.
How does that fit into the seat count?
Agentic AI is the next phase. Instead of just generating an image, you have an AI agent. You tell it, take this photo shoot, resize the best shots for 5 different social platforms, write the captions, translate them into Spanish and French, and export them to the marketing manager.
That sounds like it replaces a human, though. That sounds like the bear case.
It replaces tasks, not necessarily the creative direction. But here is the key for Adobe's revenue. That agent is consuming massive amounts of generative credits. So even if the human headcount stays flat or even shrinks slightly, the revenue per seat goes up because the agent is doing the work of 10 people and burning credits to do it.
I see. So the human becomes the conductor of an orchestra of agents, and the agents are expensive to run.
Precisely. And that human conductor needs the Adobe platform to manage it all. You can't run an orchestra of agents via a text box. You need a dashboard. You need a studio.
Okay, let's bring this back to the investment side. We started by saying the stock is trading at a discount. 19x PE versus the historical 32x. If the internal metrics are this strong and the strategy is this sound, Why is the market so skeptical? Why hasn't the stock popped?
The market is still pricing in that bear case. They look at Adobe and they still see legacy tech. They see the disruption risk from startups. They see Canva. They see Midjourney. They haven't fully bought into the idea that Adobe has successfully pivoted. They are waiting for the other shoe to drop.
But Adobe management clearly disagrees with the market.
Actions speak louder than words. In fiscal year 2025, Adobe management repurchased 31 billion shares. They spent nearly $14 billion on their own stock.
$14 billion. That is not pocket change. That is a massive bet.
It is a massive signal that insiders believe the stock is severely undervalued. They are putting their cash where their strategy is. They believe they're going to win the platform war, and they are happy to buy back their own company at a discount while the market catches up.
So to wrap this up, what are we really looking at here? It feels like Adobe has managed to pull off a magic trick. They took a business that was about selling boxes of software, turned it into a cloud subscription, and now turning it into an AI utility grid.
That's a great way to put it. They are banking on the idea that creativity is the new productivity. They aren't just selling tools anymore. They're selling the safe, integrated AI platform for the enterprise. They want to be the infrastructure that the entire creative economy runs on, regardless of which AI model is trendy this week.
They want to be the pipes, not just the water.
Exactly. They want to be the grid.
But here's the final thought I want to leave you with, and it's something to chew on. If Adobe succeeds in becoming this middleware, this layer between the raw AI models and the human creator, they win. But if that agentic AI we talked about gets really good enough to take a vague idea and execute it perfectly without a human needing to refine it in Photoshop, does the middleware layer eventually disappear too?
That is the billion-dollar question for the next decade. If the AI is perfect, do you need the tool ability? Or does the interface just become a voice command?
It's the difference between a pilot in a cockpit and a passenger in a self-driving car. Adobe is betting we still need the cockpit. Something to watch as we move deeper into 2026. Thanks for listening to this deep dive into Adobe. We'll catch you on the next one.